Good morning. This is Jim Colburn of Commodity Research Group. I'm with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and blog. We would like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone, especially those not intended to listen. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is May 12th. Good morning, Andy.
Good morning, Jim.
I just want to start out, we haven't talked to each other in about a month on the podcast, and there was a telling stat or event on April 21st. This would be the day after that prices went negative, where a 50-cent put traded $4. And what that did was it basically blew up the Black-Scholes option model. Black-Scholes model assumes prices can't go negative, and here's a zero put trading for more than, $4. So basically, if you did the implied volatility calculation on that thing, you're getting it either blows up or you get some crazy many thousands of vol points as a solution. My point is that this world that we're in now gives everyone an oh my god type of statistic. If you're a macroeconomist, maybe it's the weekly claims data or the unemployment numbers, but for me it was to see this option model. Now the model itself has had problems, and it's a mathematical model trying to replicate what's going on in reality, and obviously it's failed many times in the past, but this is a major failure of the model. But anyway, kind of describes the kind of market we're in. And to bring it to today, I thought I saw another stat that was interesting in the weekly EIA petroleum numbers, and that was in Cushing, Oklahoma. We saw actually a draw in crude oil. And let's start out with, what is that all about?
Well, good morning, Jim, and hello to everybody. It's been a pretty eventful month, but before I start to talk about Cushing, so Jim, on that 50-cent put,
yeah,
what's your break even?
Yeah, it's minus 350, right?
Yeah, minus 350.
Yeah.
So
yes,
somebody was willing to pay $4, right? And
right.
Thinking that crude was going to go back to minus 350.
Yes. Now, the minus $40 price that we saw the previous day, there were the option markets had already expired, so that you couldn't, even if you had a negative, or a zero struck put, you wouldn't have made money because it was gone. However, the spread options had about 63,000 open interests that puts that were deep in the money, and I think people missed that. They saw a lot of open interest. Like I think we went into that day with about 100,000 contracts open on the May contract, not really realizing that maybe close to 65,000 were already spoken for, so it wasn't as liquid. And then, of course, you have, I don't know how you can have somebody with maybe 30 cents in their account trading hundreds of lots of a contract that has 2 days to go, but it looks like there was some of that going on around the world. These day traders were still in the market and got caught. So anyway,
I think there's definitely a failure to police on that by the FCMs, the exchanges, CFTC, whoever you want to blame, but
And the individuals, I mean,
the individuals, right,
yeah,
who didn't understand what they were trading.
this is a layup in risk management. I don't, you gotta be, you gotta be kidding me that these folks are allowed to trade that close to expiration. We didn't even want our major oil customers doing that unless they had, some interest in the delivery process. We wanted them out
Right,
as well, and these guys were well capitalized. So yeah,
right. Again,
it was a debacle all around.
a
Uh,
debacle all around. But
I don't know if we want to do this on this podcast, but I guess with all your experience in these markets, my question is, has the collective IQ gotten better or worse or unchanged? Is it
well, that's an excellent question. Is it better, worse, or unchanged? Well,
right?
I think the more we learn, the more we don't know, right? And
Yeah,
I think you and I have been around for a long time, and we thought we've seen everything. And I think last month definitely blew my mind. And as you were saying, just somebody buying that put, it had to have blown your mind. And just an unbelievable series of events
yeah. I think
that could, who knows, it could happen again.
in previous podcasts, you say often that anything is possible, and I know when we had Andy Furman on, we talked about the possibility of prices going negative, and I think we came out of that discussion as yes, they could, because we've seen them in like grades and other commodities. It happened, but even if we thought it was a low probability we attached, and also we never would have said even minus 40 price or minus 37, So I think
No,
that was an oh my God moment for sure.
that was definitely an oh my God moment, right up there with some of the other oh my God moments and
Well,
in the
yeah,
40-year history of
yeah. I recall during the Gulf War One where somebody on the floor called me to say they had somebody was short a put spread. It was like a, I don't know, $4 or $5 wide put spread, and the market was collapsing, and they wanted to pay more than what the put spread was worth, and it would ever be worth. And the trader and this broker said, if I ever executed at that price, I'd go directly to jail because,
right.
right. But yeah, so I thought that was Gulf War One was probably the closest to this. But this is, we've talked about this before. It's the double whammy of a supply shock and a demand shock. It's you take the major oil companies were in some ways were internally hedged, where they not off they're around the world in a lot of different businesses, natural gas, chemicals. So if one part of their business was not doing so well, there's probably something else that was doing well. It's not the case right now. So anyway, with that, let's talk about what's going on now.
Yeah, let's talk about what's going on now, because there's been some changes even since we went negative. Certainly, I think the big is on both sides, on both the supply and the demand side. We're seeing some positive developments. Perhaps to me, the most positive development has been these production cuts, not only by the OPEC and OPEC plus countries, but by the non-OPEC countries who aren't part of that group, and in particular, the U.S. and Canada. U.S. production on a weekly basis probably peaked at weekly it was 13.1. Monthly, it's probably going to be 12.9. And in this week's weekly petroleum status report, it was down to 11.6. So that's already down 1.5 from the highest weekly, and 1.2 from the highest monthly. The EIA is saying that we're going to decline another 300,000 or 400,000 barrels a day in the short term. That was in the short term energy outlook, and we're going to continue to decline to 10.7 million barrels a day low in March of 21, which would be down, over 2 million barrels a day. Some people are saying that could be faster. The declines could be faster than that.
Because
Reuters.
they have a 6 month lag. They roughly say prices and production show a 6 month lag. I think so.
Yeah, but that's not been the case here.
Right.
Because production has just fallen right off the shelf.
Right.
And it's happened in all the in the Bakken and the Permian, and besides the U.S., Canada as well. The production could be down 1 million barrels a day by mid-year. And I think, we're seeing that in some of these grades on the physical market, like the heavy Canadian grade WCS. It's only like $2 under Cushing. That was like $15 to $20 under earlier in the year. And again, I think that's the factor is production is down in this room on the pipelines. Similarly, the Midland's gotten really strong, and the Houston grade is well, that's WTI Houston, but all these grades are picking up. And as you mentioned, Jim, we saw stocks draw at Cushing when all we've been talking about is stocks building and building. And I think the reason we were talking about stocks building and building, at least, in some of in my own balances, I didn't have production down quite that fast. So that's been supportive. No question that's been supportive.
Yeah, and when you look at the again going back to those commodity spread options, the flow that we've seen since basically April was just a turnaround. People started liquidating those puts, and we've seen strips of plus 25-cent calls in 2020, but also 2021. So that's kind of, if you're buying that call, you're betting for backwardation to come back very soon. And there's still oil out there, right? Or are we just flipping right into backwardation again?
No, I don't. Well, anything's possible. Yeah, could this go backwardated? If we can go to minus 40, yeah, the structure could go backwardated. I don't think it will, because even though we had a draw, inventories are still high. There is 40 million barrels of Saudi crude on the way. There's been some delay in bringing that crude into the refineries, owing to some shipping issues from taking barrels from VLCCs onto smaller ships to the refineries, and those smaller ships are a little bit, they've been harder to find, so there've been delays on that, but they're out there. They're coming, and the other thing we're seeing is runs. Crude runs were down this week, so demand, at least from a crude runs perspective, is still struggling. There is an improvement, no question, on end user demand, and that makes sense. The country's opening up slowly, but the gasoline demand numbers are increasing. Diesel demand is up. They're still dreadful, compared to where they could be or were last year, and we have a long way to go. So
just a quick perspective. Gas demand is running about now. At what levels compared to last year, would you say?
We're running well, this last weekly, and again, you can't get that crazy about a weekly, but the last weekly was 7.7 million barrels a day. The EIA is saying that May 20 demand should average 7.24. Last year, May was 9.4. So we're running, good. If that 7.24 hold, is right.
Yeah.
We're running, what is that, over 2 million barrels a day below last year. And I think it's even, it's going to end up being lower. Now, in April, we were running about almost 4 million barrels a day. I mean, April was the worst month probably ever. I shouldn't say ever. I mean,
Right.
maybe in the
Right.
1860s or
Yeah.
during
Yeah.
the Depression,
Right.
right? It might have been worse, but April, by every measure, was one of the worst months, if not the worst month ever. On both the supply and the demand side.
Yeah. I've actually filled up my tank in May. I didn't do it. I didn't touch it in
Yeah,
April. You know.
right.
So yeah.
So yeah, it's definitely opening up, but whether or not gasoline demand is going to get back to last year's levels, I think it's going to take a long time,
Yeah.
if ever,
I
if
saw one of
ever.
I saw one of those TSA. Somebody put and one of the stories was about the TSA activity at the airports, and they're talking about the green shoots, and they had a beautiful chart showing how it's bottom and now it's moving higher. And then in the same story, they mentioned, however, it's still down 90% from last year. So exactly, so it's looking better coming off of a dismal number.
Right.
Yeah,
That's exactly right.
yeah,
And maybe this summer we start seeing what the EIA is saying is demand is only going to be down 1 million barrels a day from last year over the summer. I mean, maybe they're thinking people are going to drive on vacations, but that again is going to be predicated on what happens with the virus and hotels and parks and everything else. Nevertheless, yeah, demand is improving and supply is being cut, and hence prices have been moving higher. That's, I guess, the good news. The bad news is, even though we saw draw in Cushing, we're still way oversupplied, and both products are way over. The diesel, I'll talk about diesel in a minute, but products are way oversupplied, and the EIA also says that in the short-term energy outlook, Jim, they also say that crude stocks are just going to balloon in May and June. They have stocks getting up to 580 million from I don't know. I think we're in the 530s now
hmm
by June. I don't think that's right either. But if it is, then we're back to bigger contangos, and we're back to talking about containment problems.
yeah. We're kind of in the eye of a hurricane, maybe.
Yeah, yeah.
Yeah,
So even though we're seeing improvements, all is not. It's going to be difficult for this market to really sustain sustain much more of an uptrend in my opinion. I mean, the other thing. Let's talk about structure for a little bit. There's 150, 200 million, people have different numbers of floating storage out there.
right,
What happens when the market if the market goes backwardated?
right. Yeah, that either puts a lid on it so it doesn't go backwardated, or it just comes off the market.
Right. I
Yeah.
mean, all these ships are gonna try to unload at the same time. You
What do you
know,
think? I was wondering.
it'll be ugly, and that's another problem with this market really sustaining itself.
I was going to say, I wonder if that is the Saudis cut another million barrels. Is it because you wonder how much of a if it is it policy or they're seeing the reality, or both, where they don't have ships to fill anymore, and they don't have customers to buy their stuff. So that, we have to we better cut 1 million barrels. So
Oh, I'm sure that's the case.
you know,
I don't think it's. I think it's. How they operate. They always talk about how they'll give what the market, what their customers will demand.
right,
So it's certainly possible that 1 million barrels a day was because there's not enough demand for their crude. Now, if you look at Asia, China has come back, and that's good, but India runs will increase, but that's another interesting They're talking about Indian demand increasing by 25% in May over April, but it was cut by 50%. So
Right.
it's going to increase, but it's from a much lower
Yes.
level.
Do you want to talk about gasoline versus distillate? I mean, gasoline looks like it's starting to draw. Distillate was doing well. Now it looks like they flipped or starting to flip in terms of stock levels. Distillate growing and now gasoline declining.
Jim, I looked at one of your favorite spreads uh,
Heat to gas.
right before our podcast, the heat to gas spread, affectionately known as the Widowmaker. And it went from gasoline in April, 55 cents under diesel, to gas 5 cents over diesel. So
Wow.
it had a 60-cent
Whoa.
spread, a 60-cent change. And that's, the June contract.
Jeez.
So
Yeah.
it's, yeah. And, what happened is it's really a function of jet fuel, because no one, jet fuel demand is been crushed, as you mentioned. The airlines are talking about their demand being off 90 to 95%. Flights are down 50%. The number of airplanes flying is down 50%. So if I'm a refiner, and storage was running out at the airports, so if I'm a refiner, I can't make jet fuel. And what do I make? I'm going to make diesel if I can.
Mm.
And diesel demand in March and April was pretty good, because there was still, people were stocking up on everything. They were panicking in the in as we all went into quarantine. Everybody was panicking buying toilet paper.
Right.
So how do we get that to the stores? Well, trucks.
Trucks are
So
moving.
diesel, right? Trucks
Yeah.
were moving. Diesel demand was great, and the
And
cracks
farmers
were
are plant.
great.
Yep.
They
Farmers
weren't
planting.
great. Yeah, farmers plant. They weren't great, but they were
No.
better than gasoline because no one was driving.
Right.
So here's an amazing thing. Even though crude runs were down, I think it's 3 million barrels a day last month from a year ago, we were making more diesel than we did last year.
Wow.
Yeah. I mean, just an unbelievable.
Wow.
So,
At the
refiners were cranking out diesel
at the expense of gasoline.
at the expense of at jet fuel mostly, and
Uh,
gas. Well, yeah, the gasoline yields were low as well. So, we made too much diesel. Diesel stocks built, and gasoline stocks have been drawing as gasoline has come back, and the heat and gas spreads have completely went the other way. Now, is that going to continue? This week, diesel production was down and gasoline production was up. So, you know, we'll see. We'll see.
right.
We'll see. But until jet fuel, I think refiners are still going to be making more diesel than they need, until people start flying.
Yeah, which is I hate to use that term new normal because I never think of a time when it was ever normal. There was never an old normal. But
Right.
I think you're right. I think that people are going to be much quicker to get in their cars and go on vacation than they will on a plane, um, at least for this year. But
Yeah, I think
yeah,
you're right. I think it's going to take a long time for jet fuel to get back to whatever normal. I think what we're going to see is that 2019 is going to become a baseline year, and we'll be comparing a lot to 2019. In terms of both, definitely in terms of demand. It's a record demand year, so I think it'll be, that's a year we're going to be looking at going forward.
Right. And the EIA has stocks starting to decline pretty soon, right? I think did you mention that already?
Well, the crude stocks they have building, yeah, maybe in July and August, mostly in August. I think it was July and August. They'll
Yeah.
start drawing from a very high level, at least according to the EIA.
Right. And then we start sort of drawing stocks, and then the price. We've already had a pretty good price rally from listen $6
Yeah, it
and
was 6.
yeah,
Right.
yeah. Again, it's all coming off of low levels, but do you see the market continuing to rally through these next couple of months, or do you see it? Where do you see going forward? Let's talk about crude oil.
I really think that it's going to be difficult to. I mean, could we move up another $2 or $3? Yeah. Can WTI get up to 30 or even low 30s? Yeah, I think that's possible. But then you're risking a return by U.S. producers to the market. Those that have break evens in the mid 20s may be very sorely tempted to start increasing production. If we had significantly, even into the low 30s. We're not there yet, so I think that's a worry. And another worry certainly is any kind of second wave on this virus could really be crushing. So I think the market has corrected. I think it's right to have corrected, but I think Jim, I still think we have a long way to go to get back into 40 to 50 or 50 to 60. That's going to be a long way.
Yeah, it still seems, we talked about this I think in the last podcast, that it's you almost would rather hear what Fauci has to say to tell you what's going to happen with the spreads in the outright market than the typical oil stuff we listen to. I mean, it's all about getting this virus, getting the numbers down, and getting people. Even it depends how it unfolds, but a lot of people aren't going to come out like they used to unless there's a vaccine, and even the flu vaccines we have now are only 50% effective. So it has to be something really amazing to get us back to where we were quickly, and so yeah, I guess people talk about a V-shaped or a U-shaped recovery. If we have a U-shaped, then there's a chance this market retraces a little bit, and even from these levels back down, maybe below 20. I don't know.
It's not. Yeah, I mean, it's certainly not out of the realm that I mean, we could see a very weak expiry in June. That wouldn't surprise me in the least. I think we've talked about one of June, July has had a huge rally, and one of the things that has contributed to that, I think, is that some of these some of these funds, not small, they were big, like U.S. Oil, isn't in the June, so you don't have that seller on June, July that the buyers could always rely on. The people who have to roll the other way.
That's interesting because
that liquidity's out of there.
I heard some of the press reports about U.S. Oil involved in the minus $40 oil, and they were gone. They weren't in May, but they were in June, and then
they were in June.
And the next day, they rolled about 50,000 contracts, and that was, I wouldn't. You got to give them a little. I don't know, not the major cause, but they were a cause of that price going down.
Oh, no question.
$60.
No question.
$6.
And then they rolled to June 21.
Right.
So what's happened? June 21 has gone nowhere in this rally.
Yeah.
And the rally's, the action's in the front.
Yeah, it's a really strange product. When you say, I have people say, how do you play? I want to play the an increase in price. Should I buy that U.S. oil fund? And you and I and many of our friends, most of our friends that are in this business, they just don't look at the flat price. They look at what the curve looks like. So you might have a low front price, but to by December it may cost you $5-6 to roll. And unfortunately, the sort of the benchmark for this thing is always the front month price. So,
Right.
if you stay unchanged from now, to December, and let's say that in December you're at $21, and you got in when it was front month was at 16. Say, I'm just making these numbers up. You expect that fund made $5 when really it might have lost money, right? Because you've been doing a roll. You rolled up to that 21.
Right. Right.
Wasn't you? So now it's kind of like buying a swap, a long term swap. And maybe that's a better way to do it. But I think they have to kind of, somebody has to show retail investors that when they buy this thing, what's the benchmark that they're using? It's not the front price. It's a whole bunch of prices on this curve, and I think I've never liked that thing from the get go, just because it's like an illusion.
Yeah. Well, it's been it hasn't satisfied its goals. Let's put it that way.
Yeah, yeah. I guess somebody wrote in about it being, if it was a hedge fund, it was down something like 85% since inception. It would be there would be no money going into it, but it's
Right.
still
Yeah.
attracts a lot of money, and not only retail. You get a lot of pension funds and large money people with lots of money putting.
Right. And then you have people who are trying to arb it on the short side. People who are arbing it against WTI are just going short.
Yeah, yeah.
Now they've been winners. Those who have been shorting it consistently have probably done pretty well.
Yeah, so just a couple of things. The option volume has kind of declined, and if we use a Black-Scholes vol, July is still at 93%. So that's a huge number, and bid offer spreads are wide, but we're struggling to get over 100,000 lots a day in this market. So it's kind of it's been a non-entity, and even on those 2 days where we had the big declines, you couldn't get volume over 300,000, and part of that's because the front month had already gone, has already gone by, and people were more focused on the expiration of the futures contract than they were the options. But we saw once the Tuesday traded down to 6, not only the price movement, but also, as I mentioned, the possibility was in put owners and if you were short puts and realized you put the position on before we had negative prices, and now we have negative prices, you're pretty much going to get out of that thing. I mean, it's the whole game changed. So we saw a lot of puts trade, and like on Tuesday we saw open interest in the calls increase by 30,000, and open interest in puts declined by 10,000, which was kind of telling. So my point is, it looked like we were, like a classic bottom. We had, people getting out of puts and getting into calls type of thing. And we've seen that kind of trading going on, not primarily, mostly over the last week. So on low volume. So it's kind of if you didn't know the fundamentals and you were just looking at paper flow and volumes and stuff like that, you'd say this kind of had a little bullish flavor to it. And sure enough, the market's gone up. And I posted these things in our blog and sometimes on LinkedIn, so you can, if you ever get a chance, check out our blog. What else, Andy? What do we?
Well, I think let's just talk a little bit about the global balances.
Yeah, I was going to say we haven't talked about OPEC.
We've talked a lot about U.S.
Cushing,
balances,
yep.
U.S. Cushing and gasoline and diesel, but globally, again, April was a catastrophe on every on every level, because OPEC and non-OPEC production went up, and demand absolutely dropped dead. In fact, in this OPEC report, Jim, they
Yep.
had the call on OPEC crude at like 16 million barrels a day
Oh my gosh.
in the in the second quarter.
Yeah.
So that would mean inventories were building by
Yeah.
12 million or something like that.
Wow.
Um, you know, we've been I've been doing my own balances because these numbers are so unbelievable. And what I see anyway is a second quarter bill that I think was close to 13 million barrels a day, if that's even possible, but that's what it looks like.
Mm.
Um, However, I think as we head into July and August, we're going to start drawing global stocks because OPEC's production cuts they're significant. I mean, in April, OPEC produced like 30.3 million barrels a day. And I think in May and June, they're going to be down or like 23 and a half, 24 million barrels a day. So, there are definitely some big cuts coming out of OPEC, and there are big cuts coming out of non-OPEC.
Mm.
Uh, between them, I think it's going to be something like 11, 12, 13 million barrels a day. Again, it's hard with, I hate being off by a million barrels a day, Jim,
Listen,
but
all these
that's what
numbers,
we're dealing with.
yeah, these are fluid numbers.
These are very fluid numbers, particularly on the demand side, because you just don't know. But third quarter and fourth quarter demand should continue to increase from the low in April, and from second quarter. And I think we're going to draw something like 2 to 3 million barrels a day average in the second half. But that's relative to a 9 million barrel a day build in the first half. So I think we'll get through June. I think we'll build a little bit. July, I think will be flattish, and then I think August in the second half we'll start drawing again from a pretty high level. And on the demand side, we're not who know can't be sure.
Right.
Again, if there's a second wave, we don't know. Globally, we don't know. We're in a recession now. How do we come out of that? Not, again, not sure.
Right.
But the fundamental picture is definitely looks improved as we head into the second half. But
Y-
it's improved from catastrophic. Absolutely, April was absolutely catastrophic.
Yeah. I mean, there's another thing in there that these are really deep cuts that these OPEC members are making, and I guess it's Iraq is still a little slow to get going on theirs, but as we start, like you said, as we start drawing, you also have the possibility that a lot of oil barrels get leaked into the
Oh,
system.
totally.
You know,
Yeah,
so
totally. Right.
um, so there's probably some cap on the market. Understood. It's hard
Oh,
to.
yeah, because first of all, Libya's off. I mean, Libya didn't really produce, and they produced like 100,000 barrels a day in April. So,
Right.
that there could be a million right there. They're not even in the quota. The one big surprise in non-OPEC has been Russia. Russia pledged to cut 2 million barrels a day of crude, not condensates for crude. And you know what? In the first week in May, they did.
Mm.
So that was really, I thought there's no way. And they've been saying this whole time, we can't cut because we're going to damage our fields, blah, blah, blah.
Yeah.
And,
Yeah.
right. But they did cut. And as I said earlier, Canada, US, Brazil, Norway. So we're seeing significant cuts, more than I thought, Jim. Way more than I thought we'd see.
Yeah. It's hard to gain market share when there's no market.
Exactly. Yeah, that's exactly right.
This we need demand. Yeah, April is a bad month. I think even for oysters, right? Isn't that a bad anything with
I
oysters?
think it
Yeah.
is. I think it is.
Uh,
One thing that I think these cuts have prevented is the containment issues. Because now with these cuts, we're not going to get it's unlikely we're going to get to absolute tank tops on everything. And the other thing
Right.
is there's going to be ships around, so floating storage, which doesn't pay now anyway, if you look at the contangos, but so you can still put stuff on ships
Right.
if you had to, but we're not going to get to the absolute containment, and I guess that's good. That's good. Maybe.
Maybe. Well, I know that tomorrow things will look a lot different than what we're talking about today. So we'll continue to track this. And, like I said, I talk to you pretty much every day. And I try to post things on our blog every day. And it's usually an interesting article that we're talking about. And I'll post it, or sometimes it's my own stuff on the crazy world of options. And it might be worth checking it out every now and then. And so let's stop it there, Andy, and we'll pick this up in another month.
Okay, and you can find that blog on commodityresearchgroup.com. And if you have any questions, feel free to reach out to me, Lebow, at commodityresearchgroup.com. That's ALEBOW at commodityresearchgroup.com.
And also look for Andy getting quoted in virtually every newspaper. And are you doing any interviews these days, Andy?
Um,
Canadians don't want you anymore?
I was on a couple of months ago. Yeah, I think they don't. Now that my hair is growing back, I think I think they're cutting me.
Right. Very good. Well, till next month.
Okay.